Good evening, everybody. Thank you so much for joining us this evening. We had a lot of interest in this topic, and rightly so, navigating our taxes as an Australian permanent resident or a citizen with a financial ties in India can be really difficult. With the new budgetary changes, I think it's a perfect time for us to review the tax implications of an Indian income and Indian assets with respect to Australian tax laws. And the new tax rules are expected this week. Probably, we will have another webinar considering all of that changes. Let's see how we go forward from there. Before we begin, I would like to just give an overview, 20 minutes of presentation, giving you practical tips and tricks, and 10 minutes for Q&A, and you can drop your questions at the chat box. So we have a disclaimer. This session is general information sessions only and not a personal tax advice. Consult your tax experts before making any decision. Now let's dive in to first one. I'm just trying to cover fundamentals here for the benefit of our audience. Just trying to give you, background, fundamental tax rules. Then I'll share, practical tips and, how it affects our taxation. One of the biggest misconception is that, if I don't bring my funds to Australia, I don't have to declare them. Unfortunately, that is not true. And if you are a permanent resident, a tax resident or citizen of Australia, you are taxed on your global income. That means any capital gains from your property sale or any other income must be disclosed in your Australian tax return. The system is getting smarter, and the data matching and overseas transactions are being tracked, and more people are receiving tax notices for undeclared foreign income. Even if you have already paid tax in India, you still need to disclose it here. But don't worry, there is a double taxation treaty benefits between India and Australia, and dual tax exemption is going to save you some taxes in either side. Another fundamental question is about the financial year. In India, the financial year is 1st of April to 31st of March. In Australia, the financial year is from 1st of July to 30th of June. We need to disclose a income for Australian financial year and rework, Indian financial year income and disclose it. And it is very important during the capital gain transactions because you don't want to sell your properties in April, May, June because of the overlapping months. Probably December is the better time to sell your. There is a major change which happened on the capital gains tax in the last budget, which is a 12.5% tax liability. So without a indexing benefit, that means any capital gains, your sale price minus cost price, without indexing, you will have to pay a 12.5% tax. But this is not the case for residents and non-residents. The residents get to choose between indexing or non-indexing, whichever is beneficial to them. For non-residents, we have to pay 12.5%. That means we will end up paying more tax in India. Maybe that is not a bad thing because we are, Australia is a high tax country. Then probably probably we can use foreign tax credit much more efficiently. But for us, we will get a rollover benefits. What is rollover benefit? We can invest in another house, or we can invest in a bonds, up to 50 lakhs rupees. But depositing in bonds in India will give you tax exemptions in India, but the bond is not recognized as per the Australian tax rules. I know the double taxation treaty benefits, which is a very, very useful for us. Whatever the taxes which you paid in India, you can claim it in Australia, subject to foreign tax credit rules. Foreign tax credit rules will help you to reduce your tax liability. The whole idea is that same income should not get taxed in the two different countries for the same person. So please make use of this. This is where you're going to save a lot of taxes. Otherwise, would have been a really difficult situation. One other thing which I would like to highlight is a lower withholding of tax certificates. Our withholding tax is at 12.5%, and on sale price. See, the tax is 12.5%. The withholding rate is also 12.5%. The 12.5% withholding rate is on the sale price, and they will deduct that and remit it on your behalf with the government. Then, if your tax liability is lesser than 12.5% of the tax withholding, then you can claim a refund. Alternatively, you can apply for a lower withholding certificate, which will, get a 5%. In that case, your refund will come down. At the same time, the cash flow will improve. It's a really good idea if your tax liability is very low, but plan it accordingly. The last thing what we want is our money is getting stuck in Indian bank account for not having enough documentations done at the Indian banks. So as you may know, we can't have a savings bank account. You need to have an NRO account. Um, NRO bank account is must, and it is not having an account, or having a savings bank account is an illegal. And PAN card has to be updated with an address and phone numbers and your residential status, so that the withholding tax wouldn't apply. See, if a resident Indian wants to transfer the funds more than 10 lakhs rupees, they will go through a withholding of tax. For us, it's a different benchmark, so that's why it's very critical to update your PAN number. Um, then the KYC documents with banks, which is critical as well. Then lodging your previous ITRs if you're planning to sell your property. If you don't have to lodge your ITRs, and if you have not disclosed those income in India, probably it's not a bad idea to lodge your previous ITRs. Keep transactions ready, I would say. Apart from these basic fundamental changes, and I would like to bring your notice to these 3-4 major changes which has happened. I will share each points with a kind of an example to understand it much easily. If you are holding a property as a joint property, right, joint property ownership, that means you can have a property with your spouse, which may not be a really a big issue because both of you will be a non-resident, should be okay. But if you are having a property with your parents or with your siblings who are Indian residents, then tax rules for Indian residents are different from tax rules for non-residents. So when you sell your property, then the capital gains are computed very differently. What works for a joint owner in India may not work for you. You need to be really, looking at your situations and plan it well in advance, because selling a property in India is not an easy task, and there is so many moving parts, and this is something which you need to be aware of. Major changes in bank nomination rules. So, you need to have a nominee. It is applicable for all the bank accounts, FDs, NRE, FDs, and everything. Please make sure that, while updating the KYC, make sure that the bank nomination rules also been complied with. I don't know how many of you have heard about an HUF, which is a Hindu undivided family structure for the tax benefits. If you are a joint family, you can have a HUF as a tax structure, and which has a different PAN number and a different tax benefits, which may not be suitable for all of you, but those who have a very high net worth, uh, those who have a high net worth can definitely explore the HUF structure, which is very acceptable in India. I'm coming to the last point here about partition and the inheritance tax law. What is partition? If you have a property which is kind of inherited from your grandfather, then how the property is divided between the family members is through a partition deed. Once you have this partition deed, you literally become an owner of the property. Once you become an owner of the property, you are an Australian permanent resident or a citizen, you're owning a global asset. So all those rules would apply. So if you are inheriting a property, please be aware that this is something which you need to be looking at. And inheritance tax law is another aspect. Just imagine, your parents wants to, distribute the properties between all the kids. Or is it beneficial for you? Or, it's a family circumstances, anybody can understand. But is inheriting the property, especially if it is an agricultural property, then it's a different rules. So inheritance versus dividing the property by the family members is something has something very different. Just I'm sharing these points to think about it, and so that you can have a better tax planning done. I've covered the asset part. Now I'm just covering income part. So what income exempted in India doesn't mean that it is exempted in Australia. Just take an example of an agricultural income, which is exempted in India, but it is taxable in Australia. Interest income, NRE deposits. So, it is fully exempted in India. Then a lot of our clients got a tax notice because of a data matching on the NRE deposits, because it is fully taxable here in Australia. Same case with dividends. The rental income is a totally different one. All of us have investment properties in India. Rental incomes are subject to TDS. TDS at a higher rate. Then we need to lodge the tax returns in India and claim a refund in that case. But all those expenses which is allowed in India is not allowed in Australia. So in rental income has to be reworked, recomputed as per the Australian tax rules, not as per the Indian tax rules. So you have to take a gross income, then you deduct all those expenditures and arrive at a rental income, which is totally different from the net income which you arrive for Indian tax returns. Capital gains, I think we have covered everything in detail. Mutual funds and shares, sale of mutual funds and shares are subject to a capital gain tax, and cost base needs to be worked out in a very efficient manner, so that you have all the corresponding documents apart for that. Then comes gifts. I'm covering gifts in the next slide because we know that's very important tax planning tool. and the pension funds. A lot of us withdraw EPF and PFs, and which is, partly exempted in India and partly taxable. However, PPF is taxable in Australia, but not entirely, only portion of which is taxable in Australia. Make sure that you identify the taxable portion and declare and disclose it in your tax return. Insurance, if it is a pure insurance, it is not taxable. But if it is a hybrid insurance where your insurance plus the investments, that is when the challenge that's where the challenge is. The investment portion is subject to Australian tax rules, and any income which you have earned with respect to that investment is subject to taxation at all. Other incomes. Let us take an example that grandfather has given a 50,000 rupees FD for the grandkids here, and the grandkids are, if they are below 18, then they are subject to taxation at a higher rate. So even if it is not your income, but your grandkids are having a properties or income in India, that will be clubbed along with yours. So just be mindful about that situation. And the business income, which is again is taxable in Australia. Then I'll come to the point where gift of cash and assets. As you may know, there is no gift tax in India, there is no gift tax in Australia. However, gifting between family members are exempted in India, but that is not the case in Australia. So if you're gifting a property within the family members, it could trigger a capital gains tax. So, and there is another very important aspect that don't assume that you have transferred between the families and it is gift, unless you have a documentary evidences like a gift deed or any other documents. It will not be treated as a gift. It can be treated as a loan. If they take it as a loan, then it has a different tax implications altogether. So make sure that you have all those documents in place. Inheritance versus gift, that is where you need to be really careful of this Benami Property Act, which start to take effect now. So when you have an inheritance and there is a gift involved, then be mindful of Benami Property Act. And there is enough information in the internet now. So I'm just highlighting these points so that you know what exactly you need to look for. How much can we bring it to Australia? $1.3 million, or it's not at $250,000. $250,000 are applicable for Indian resident. For us is 1.3 million Australian dollars per financial year. Our team does, CS certification, 15CA, 15CB, coordinate with the banks and making sure that your funds are repatriated directly to Australian bank account. It's an easy process, and most of the time the funds are getting deposited into the NRO account. It will never get deposited into the NRE account, and you don't have to transfer it from NRO to NRE to repatriate it here, and you can transfer it from NRO account directly to your Australian account. We issue a certificate, bankers will verify all the certificates, then they will transfer the funds directly to Australian bank account. Here is a takeaway and to-do list, very practical, a list for you. What do you need to do in Australia? Disclose all your Indian income into your Australian tax return, even though it is a below taxable limit in India. So even if it is $1,000 income in India, that needs to be added to Australian tax return, because you can't claim basic exemptions in two different countries. So we are claiming basic exemption here, so you can't claim basic exemptions there. And take the clause 20, where if you have property over $50,000 outside Australia, then in India, pretty simple, convert your savings account into an NRO account, update your PAN, make sure the IT tax office reflects a non-residential status, log into your tax portals and look for any tax notices or demands or issues there, and keep it clean. Lodge your tax returns in India and make an advance payment before March, so that you don't get any extra interest or a penalty. And we don't have to have Aadhaar, but if you have one, there's no harm in linking it with PAN. It's easy and less issues. And you can also compare your tax liability with the new income tax rules versus old income tax rules. And that is where you can save some taxes. We offer a written tax advice for Australians with respect to Indian transactions as well as the Australian transactions. We lodge Australian tax returns with Indian income, and majority of our clients are, we are able to get them a dual tax benefits. That is where they are going to save most of their taxes. And we can assist in selling your properties and connecting with the lawyers and the real estate agents in India. At the same time, we can connect you to a real estate agents, lawyers, and financial planners, or a mortgage brokers in Australia. And thank you for attending this session. Please leave your questions at the chat board. Then I'll try and answer them as much as possible. And thanks once again.